Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Friday, December 20th, 2019. Here are our top stories. What is index investing and should you invest? And then we'll take a look at the latest trends and what you can expect in 2020 and beyond for index investing. Well, the passive versus active debate has raged for decades. Joining me now to break it down, give us the basics about investing, Craig Lazaro. He's a managing director and head of global index investment strategy with S&P Dow Jones Indices. Craig, welcome to the program. Thanks for joining us this morning.
Jeff, thank you. Delighted to be here.
It's great to see you as well. So you're the head of global investment strategy for S&P Dow Jones Indices. And I think top of mind for our listeners and viewers today, let's break it down into simple terms so that even I can understand. Can you just talk about indexing in general and what that means? I think that's an important concept for people to hear.
Sure. Well, at the simplest level, an index is just a portfolio of stocks. Originally, indices were put together pretty much universally by either journalists or stock exchanges because they wanted to have a way to communicate to people how the stock market done. So the Dow Jones Industrial Average was started by the editor of the Wall Street Journal. Some of our competitors also have a journalistic background, so that's quite common. What people discovered as years went by is not only were index funds, or indices, I should say, good indicators of what the stock market was doing, but when people came to compare the performance of actual managed portfolios against the performance of indices, what they very often found was that the average actively managed portfolio underperformed an index of the stock market. So in the U.S., for example, the average actively managed portfolio underperformed the S&P 500. And that insight, that observation, then led to the growth of index funds as apart from indices. And indices are just paper portfolios. Index funds are actual portfolios with real money. And that trend in the U.S. started in the 1970s. It has grown quite dramatically since then. Initially based around very general indices like the S&P 500, and since then becoming much more complicated ecosystem, as you know.
Yeah, and so for the you mentioned index funds, and another way of describing these funds are passive, PASSIVE, passive investment options. And so there's a number of different vehicles, investment vehicles that consumers, both retail and institutional, can use. And so they would be, for example, mutual funds and something called exchange traded funds. And there are differences between the two.
Yes, yeah. And the mutual funds are, a passive mutual fund or an index mutual fund is exactly, from the consumer standpoint, it's like at any actively managed mutual fund. You buy it from the fund company. It's open-ended. You can buy as much as you want. You trade once a day at the end of the day at net asset value, just as you would for any actively managed fund. And that was original when indexing started in the U.S. Of course, the very first index mutual fund started, I believe, in 1976. It's, of course, grown dramatically since then. ETFs, exchange-traded funds, started in 1993 in the U.S. The idea behind an ETF was to say, instead of having a fund that trades only once a day at the market close, suppose we packaged up securities in such a way that they could be traded during the day in the same way that any stock is traded. And so that was how ETF started. And the first of those, I say, was started in 1993, also tracking the S&P 500. And so the difference between ETFs and mutual funds, well, there's several. One is the obvious one we stated already. ETFs can be traded at any time you want during the day, so you trade them in the same way you trade stocks. You have limit orders, things like that. So they're like stocks from a trading standpoint. Often, although not always, they're a bit cheaper in terms of management fee. ETFs also have certain tax advantages that are kind of technical, but but it's easier for the owner of or the manager of an ETF not to report taxable gains than it is for the manager of an open-ended index fund or open-ended mutual fund, I should say. There's some technical reasons behind that we don't need to delve into, but that is a fact, and that's one of the things that has helped the growth of ETFs.
We often in the retirement industry, people often look at fees and they often look at performance. And you mentioned the start of the ETF in '93, the beginning of passive or index investing, index mutual funds. I think you mentioned in the late '60s or into the '70s. But we have seen a tremendous amount of growth and a shift in assets to the passive investing suite of options. Is that really just based on fees and performance, or are there other rationales? Because it's really grown considerably over the years. I know I've been in the space for a long time, and we've seen a real shift from active into passive.
Yeah, no, it's been quite. I think it's not generally understood outside of specialists like you, but I think the shift from active to passive has been one of the great stories in economic history in the past 50 years. But our estimate, no one knows this for certain, but our estimate is that between, let's say, a quarter and a third, to give you a very broad range, of 25 to 33% of all of the entire U.S. equity market is held by index trackers, so things that track the S&P 500 and mid-cap 400, our competitors as well. And there are more specialized things that I'm not counting in that 25 to 33%. But that's a tremendous growth because, as you noted, 50 years ago that number was zero. So what has led it to happen, I think, is exactly as you suggest. It's a story about fees and performance, and it started. We mentioned earlier. It started with an observation. The observation was that most actively managed funds were unable to outperform an unmanaged index on a consistent basis. Well, the obvious thing to say is if I can't outperform the index, maybe I can own the index, and so you had an immediate performance benefit from that shift, coupled with the fact that it's cheaper to run an index fund than it is to run an active portfolio. An index fund needs relatively little infrastructure, trading clearly, and ability to manage the market, but you don't need to hire an army of fundamental analysts. You don't need to have strategists. It's a cheaper way of trading, and because you trade less frequently, transactions costs are less. So those things have cascaded. Now there's a range of things one could say about why the performance of index funds is superior in general to that of active funds, and I'm happy to go into that. But the fundamental reality that people should understand is perhaps paradoxically, because it doesn't feel right somehow unless you really delve into and study this, to say that an index that's designed simply to reflect a market average on to average over time does better than a group of skilled professionals who are trying to outperform. It doesn't seem like a very natural thing, but in fact that is very, very clear in the data all over the world for many years.
And Craig, just based on my own anecdotal, talking with individuals on this program and outside of the program, the market returns, it used to be that you would assume 8%. Remember the days of 8% returns year over year? And, many pension funds, as an example, are now lowering their assumed interest rate. And I would imagine that kind of tied to the sentiment that you're describing is that, you have to look for other ways potentially to drive return and drive alpha to get those returns, whether it's a pension portfolio or it is a foundation or endowment or some other investment pool of assets.
Well, the expected rate of return on the equity market really has nothing to do with the percentage of the market that's held by index versus active managers. But your observation is correct that pension funds are having to reduce or should be reducing their assumed rate of return. And there are a couple of reasons for that. The most important one, of course, is that long-term bond rates are very low. And that, more than anything else, the decline in interest rates is what has exacerbated the difficulties of pension fund sponsors in keeping up. The equity returns have been quite good, as you know. I mean, we're going to be up double in the 20s unless something disastrous happens the next week. We'll be up in the 20s for the S&P 500 for calendar 2019. So equity returns have been good. The real driver of the pension problem is low interest rates.
Yeah. Well, Craig, I want to go to break, and we come back. We're going to talk to Craig about maybe some of the future trends when it comes to passive investing. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings in retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We're discussing index investing, the basics there, and now we're going to look at some of the latest trends and things you can expect in 2020 and beyond. We're joined by Craig Lazar, Managing Director with S&P Dow Jones Indices. Craig, thanks so much for sticking around with us this morning.
Thank you.
So before we go into the trends, I really want to talk about something that I picked up on in our conversation, and that was this underperformance by active managers versus passive managers. And I got to think that this is not a random occurrence. Like, this isn't like flip of a coin and underperformance. And there's got to be some real reasons for some of that underperformance or that underperformance.
You are absolutely right. There are a number of reasons, and I'll mention two, maybe three. The most obvious one is something we alluded to earlier, which is cost. It costs more to run an active portfolio than it does to run an index fund. You have to have analysts, traders, and so forth. So the fees on the average actively managed fund are greater than the fees on the average index portfolio. The most recent numbers I've seen say that difference is something like 60 or 70 basis points per year, which means the average active fund starts 60 basis points or 70 basis points in the hole. So that's the first reason. The second reason has to do with just the nature of the investment management business. All of the investors in the U.S. stock market own all of the stocks there are to own. So it's a closed system in that sense. What that means is that if I'm going to be above average, somebody else is going to be below average. There's no source of outperformance for the outperformers other than the underperformance of the underperformers. Now, if you're in an environment or in a market where the majority of assets are controlled by what I lovingly call undiversified amateurs, My grandmother was on it. So I don't mean it. It sounds pejorative. I don't mean it that way. But undiversified amateurs, theoretically, not practically, but theoretically, all of the professionals could be above average. What had happened by the early 70s, however, was that professional asset managers had come to dominate the U.S. market, which means that the average professional is competing not against an amateur, but against a professional who's had the same training and has access to the same technology and the same information that he has. That's why, Jeff, I think parenthetically, the index business, the index fund business started in the 1970s. I mean, it could have been 20 years sooner or 20 years later, but it happened in the 70s because by then the U.S. market had become almost, well, not entirely, but largely professionalized. And when a market is largely professionalized, it's very difficult for the average professional to outperform.
Yeah.
A third reason relates to a concept that we call dispersion. Dispersion just means the spread in returns among the stocks in an index. So there's some environment or some months when the range of returns, say for the S&P 500, is very, very large. Sometimes the range is very small. If the range is small, the opportunity for active managers to add value is constrained. Not because they're not skillful, some of them are, but not because of their skill is any less, but because the range, the opportunity for them to exercise that skill is less, the value of their skill is less. And since roughly 2011, dispersion in the U.S. has been well below its long-term average, which means that even a good active manager is going to be hobbled in terms of his ability to add value. And that shows very clearly in the statistic, performance statistics for the last half dozen years. It's been a particularly tough time for active managers.
Yeah, and that's important for consumers to know. I mean, it's not a slight against any in particular, any type of management or company in particular, but I mean, it's just the reality, the historical reality. So, Craig, let's put on the look forward cap, and let's talk a little. We've got a couple minutes left. Let's talk about some of the trends that you see in the future, because I would presume that you're not only working with pension funds or those types of plan sponsors, but you may also be working with other types of asset pools like sovereign wealth funds or endowments, foundations, large asset pools, and they need help with active and passive management. So can you just kind of give us some ideas about trends that we might see in the future?
Yeah, I think the most important, well, two things. I'll give you two. One is, and you mentioned this earlier, the movement from active to passive continues. I mean, that will not slow down anytime soon, I don't think, for all the reasons we discussed. Another way to say that is, and this is relevant to the large institutions you mentioned, as well as to financial advisors and individual investors, if you opt for active management, which many people choose to do, many smart people choose to do, realize the odds are against you. It might work out fine, but the general rule is that most active managers underperform most of the time. As long as that is increasingly well understood, money will continue to move from active to passive. Now, within the realm of passive, I think one of the most interesting things we've seen in the last 10 years, certainly, maybe a little bit longer, has been the growth of what I like to call factor indices, the more common term by which people refer to them as smart beta, which is not a term I particularly like, but that's what people use. What factor indices aim to do is, instead of replicating them, it's like the S&P 500 replicates the U.S. market, and typically large cap stocks. S&P small cap 600 replicates small cap stocks and so forth. What factor indices aim to do is to give investors access to a pattern of returns, which is not necessarily market-like, or access to a factor that they couldn't otherwise have. And when I say factor, Jeff, I mean, it's kind of in an academic sense, an attribute with which excess returns are thought to be associated. So, for example, coming on 30 years ago now, Fama and French wrote a famous academic article saying small size and cheap valuation were factors of return. Momentum is generally thought of as a factor of return. Stocks that have been going up typically keep going up, at least for a period of time. Low volatility is a factor of return. Quality of factors of return. And what we've seen in the past 10 years is a migration of assets, not just to first-generation indices like the S&P 500, but to factor indices like S&P 500 quality or low volatility, which give investors access to a pattern of returns that you used to have to pay active fees to get. And because of the growth and proliferation of factor indices, they're now able to access these kinds of strategies without having to hire an active manager, without having to pay active fees, and without having to endure the possibly negative effects of active stock selection. One of the things that I think is particularly apt now, if you think about where we are in the market, headline a few minutes before we began recording was that the market, the S&P 500, had reached an all-time high. Other indices similarly. It's a bull market's been going on for more than 10 years now. It's a natural thing for certainly I think it is a natural thing for investors to think in an environment like this, maybe I should begin to take money off the table. The traditional way to do that is to buy bonds or put money in cash. That's not as attractive an alternative now as would have been the case traditionally because interest rates are so low. Mm-hmm. So one of the things that I suspect we will see, we have seen in the past year, I think we will continue to see, is a movement of funds both from active managers or perhaps from S&P 500-like index funds into defensive factor indices, things like S&P 500 low volatility, quality, dividend aristocrats, all of which tend not to do quite as well as the market as a whole if the market goes up, but tend to do better if the market declines. So they're a way to become more defensive, but still maintain equity exposure.
Craig, we've got about a minute and a half left. One of the big issues in the retirement space is the drawdown or what we call retirement income. And traditionally, annuities are a conversation. You've got deferred annuities, fixed annuities, variable annuities. I mean, there's a plethora of different types of annuities. But I want to get your perspective on the index and how indices might be able to be used in that retirement income scenario. I think that's an important future construct that people need to think about.
Of factor indices. There are some factors, low volatility, dividend yield, quality. When I say quality, typically it's profitability and low leverage. Those factors tend, to decline less if the markets decline, so they're defensive, which people like in a retirement situation, and B, typically have higher dividend yields than the market as a whole. So from the standpoint of what might an investor own that would deliver above average yield and still have a defensive character and yet maintain equity exposure, those sorts of factor indices, I think, are a solution that lots of people have found interesting.
Yeah, well, certainly something to think about. Craig, I want to thank you so much for joining us on the program and sharing your expertise. Certainly enjoyed it, and we look forward to having you back in the future.
I look forward to being back, Jeff. Thanks very much. Pleasure to be here.
And that wraps up this episode of BRN AM. Hope you enjoyed it. Hope you found it educational. I know I certainly did. And don't forget, tomorrow we're back with our look back show, our retrospective for the week, BRN Weekly. Hey, have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, so much more, check out today's edition of The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.
But if you're tired of the same